we're going to learn what credit default swap is, how it works, how it affects the financial market, and the valuation of credit default swap. A credit default swap, or CDS, is essentially an insurance contract between a protection buyer and a protection seller. It insures a corporation's, or aka the reference entity's, specific bond or loan. A protection buyer pays an upfront amount and yearly premiums to the protection seller to cover any loss on the notional amount of the reference bond or loan. So here we have three main players: the protection buyer, the protection seller, who are typically banks or insurance companies, and the third party, which is called the reference entity. Suppose there's pension fund A that has a lot of money to invest, and there is company X that needs money for their new project, so they are issuing 5-year bonds that pays 10% coupon per year. Company X has been rated by a credit rating agency as a BB company. Pension fund A wants to invest $1 billion in company X's bond. However, pension fund A can only invest in AAA rated securities, and because company X has a BB rating, pension fund A is not allowed to make this investment. To invest, pension fund A can go to AIG, an insurance company with a AAA rating, to buy a CDS. The way it works is, pension fund A protection buyer, pays AIG, the protection seller, a premium, and in return, AIG gives pension fund A insurance against default. Because AIG is a AAA rated company, the BB rated bond now becomes a AAA rated investment. Now, pension fund A can invest $1 billion in company X or the reference entity's bond and receive interest of 10% per year. Because they have a CDS contract, pension fund A has to pay AIG a premium of 1% of the notional amount per year. If company X defaults, the bond value becomes worthless. AIG will pay pension fund A the notional amount of $1 billion minus what pension fund A can recover from company X. This may seem like a good deal for both buyer and seller. Pension fund A gets effective interest rate of 9% per year, and even if company X goes bankrupt, the bond is still insured by AIG. And on AIG's side, they will get 1% of $1 billion per year without any upfront investment required. But there are some issues from CDS that led the US economy to financial crisis. The first issue is banking regulations and the lack of funding requirements for CDS. Banks are required by law to hold a certain amount of capital for loans they make. But there are very limited capital requirements for CDS, so banks and other CDS market participants can take on much more credit exposure through CDS than they could directly. Another big issue is that CDSs were not traded for its real purpose as a hedging device against the default of a bond or loan. Rather, it was more commonly used for speculations, as speculators placed their bets on the credit quality of a particular reference entity. Suppose you believe that company X is in trouble and will default on its bonds. You can speculate by buying credit default swaps on their bonds, which will pay you the full face amount of the bonds if they do actually default. On the other hand, if you want to speculate that company X's bonds would not default, you can sell CDS to speculators who hold the opinion opposite yours. Then you will earn the money from the premiums and never have to pay off on the insurance. So let's take a look at how the crisis started. One of the main implementations that caused the financial crisis during 2008 to 2009 is an adoption of the Financial Modernization Act of 1999, which led to a long period of deregulation in the U.S. financial industry. As a result, derivatives became more and more popular. The expansion of household debt was financed with mortgage-backed securities and collateralized debt obligations. Investment banks brought incredibly large amounts of mortgages from homeowners and securitized them into CDOs, which are cut into different tranches. Later, they sold them to investors. the investment bankers make the AAA grade on the CDOs as the safest by banks insured with a small fee with CDS. Since CDS was a very attractive and easy way for banks and speculators to gain money, many financial institutions got greedy and sold protections of the same loan not just once, but as many as 10 times. As banks wanted to find more homeowners, but there was no good credit, so they decided to accept subprime borrowers, and this led to the start of the financial crisis because they could not repay the loans. When U.S. home prices declined steeply after peaking in mid-2006, adjustable rate mortgages began to reset at higher interest rates and mortgage delinquencies soared. Mortgage-backed securities, including subprime mortgages, lost most of their value and began to default. Institutions that have offered credit protection on risks far in excess of their current capital will quickly be unable to pay claims. Their counterparties will suffer unexpected losses even though they thought they were protected by a CDS. There are two sources of likely loss on CDS: default by the underlying borrowers, the companies that originally took out the loans, and default by the banks or other financial firms that bought the credit default swap, counterparties in the endless chain of banks, insurance companies, and hedge funds that have done these deals. The total outstanding balance of the CDS market is $50 trillion, compared with the entire U.S. home mortgage market at about $11 trillion, and the subprime part of that market at only $1 trillion. If a borrower defaults on a loan, the bank can still recoup some of his money by taking possession of the house and selling it. This isn't the case with CDS. They're based on an action, like a bank failing, not a thing, like a house. And because of their intangible nature, finding a source of capital to cover CDS payouts is less exact. And the potential losses from the credit default swap market dwarf those seen from losses associated with subprime mortgage-backed securities. So what happened to CDS companies after the crisis? In 2008, the U.S. commercial loan market is worth about $5 trillion, yet the volume of CDS outstanding is currently no less than $50 trillion. In other words, a huge number of traders, salesmen, and quants have been making money off this product without any real hedging rationale at all. American International Group, or AIG, along with MBIA and AMBEC, face ratings downgrades because widespread mortgage defaults increase their potential exposure to CDS losses. AIG was also required to post additional collateral with its trading counterparties, leading to a liquidity crisis and essentially bankrupt all of AIG. The United States Federal Reserve Bank stepped in to bail out the company, enabling AIG to deliver additional collateral to its credit default swap trading partners. The monoline insurance companies went out of business in 2008 to 2009. CDS market today. 5 years after almost blowing up the global economy and 8 years after making fortunes for Wall Street traders, the credit default swap market is quietly fading. Rules introduced in the wake of the financial crisis by US and European regulators have led investment banks to withdraw from the market and made trading credit default swaps and other derivatives more expensive. And with the Federal Reserve keeping interest rates near historic lows, fewer borrowers have defaulted, which means less demand for debt insurance. As a result, outstanding credit default swaps on individual companies declined by about half, to $13.2 trillion from 2007 through June 2013, according to the Bank for International Settlements. Dealers once offered $5 billion trades, now $500 million is more typical. For our final subject, we will be looking at the valuation of CDS. For a CDS contract, its price is the premium that the buyer has to pay to the seller. This premium, or spread, can be measured in percentage of the notional principal that the lending company or the protection buyer gives to the borrower or reference entity. So what we are essentially trying to do is find a spread that equates the present value of the payment made by the buyer to the present value of the payoff made by the seller. This is to ensure that both parties get a fair deal. The payment made by the CDS buyer consists of two scenarios. One, the reference entity does not default and the buyer has to make payments to the seller. Or two, the reference entity defaults and the buyer owes the seller accrued portions of the premium payments. To better understand this, let's take a look at an example. Let's assume that defaults happen at mid-year every year throughout the life of the contract. The buyer of the CDS makes payments annually. The risk-free rate equals 5% continuous compounding. The recovery rate equals 40%, which means that if the reference entity defaults, the buyer can recoup 40% of the notional amount. The life of the CDS contract is 5 years, and the probability of default is 2%, meaning that each year there is a 2% chance that the reference entity will default. We start off by finding the present value of expected payment. If the reference entity survives, the buyer of the CDS will have to make payments to the protection seller. Thus, in order to find the present value of expected payment, we multiply the probability of survival by the annual payments that the CDS buyer has to pay. Then, we discount them back to present value using discount factors. We do this for each of the 5 years and sum them up, and this gives us the present value of the payment that the CDS buyer has to pay when no default occurs, which is 4.0704 multiplied by the spread. If the reference entity defaults, the CDS buyer owes the seller accrued portions of premium payments. Also, remember that we assume that defaults happen mid-year, so the expected accrued payments can be calculated by multiplying the probability of default with 0.5, because out of the chance of default, the buyer is going to accrue only half the amount. Then, we repeat the process we took in the first step to get the present value of accrued payments in the case that the reference entity defaults. Here, we get 0.426 multiplied by the spread. The third step is to calculate the present value of expected payoff, keeping in mind that the seller only makes payoffs if the reference entity defaults. The expected payoff is the payoff portion of the notional amount. It can be calculated by multiplying the probability of default by 0.6, which comes from 1 minus the recovery rate. Then, we discount all the expected payoffs in each year and sum them up to get an expected payoff of 0.0511. The last step is solving for the spread. From the equation we mentioned before, stating that the present value of the payments made by the buyer should equal to the present value of the payoff made by the seller, we can solve for the spread that the buyer has to pay. In this case, the spread is equal to 0.0124 or 124 basis points.